get in more details on what we're likely to hear once the trade deal gets signed. Julian Brigden, co-founder at Marco Intelligence Partners, joins in on the show right now. Julian, the first phase of trade deal, hopefully it's going to be signed today. What do you think is going to be the impact, if at all tariffs are not moved? And do you see the market is priced in any negative possibility as of now?
Well, look, I think a good trade deal is more than discounted at this point, or what we're going to get is more than discounted. I think it's plainly obvious that when you look at what the real concrete elements that we don't know a lot. As we said, we're going to get this document, but we're not going to be able to see many details from it. I'm sure they'll be leaked over time. But the reality is that this is not an outstanding deal. Trump hasn't got the IP breakthrough that he would like. I'm sure they'll try and spin it that something's coming. But the reality is what we've done is that we've increased tariffs. Those are going to continue to weigh on US sentiment probably into the second quarter. Typically, they take about 9 months, the tariffs, to kind of work their way through the system. The good news is we didn't get the increase in the December tariffs, which would have been really problematic. We've done some sort of deal with the Chinese to, that they're not going to be labeled as a currency manipulator. As I was just saying on your program earlier, I really don't think that stands the smell test there. I think you can see the PBOC's fingers controlling volatility across a lot of the FX markets just by the nature of how they manage their reserves. But, as I said, they're going to spin this as well as can be expected. I think the bigger thing is, would something break down leading into stage 2? But now Trump has kicked stage 2 past the election. OK, so we've got another, 9 months, 10 months to wait until we see anything there. So they can keep spinning these things when things get bad. In the markets, they can amp things up and say something is actually going to be good. But the reality, I think, when we stand here in probably 5 years' time, we will have seen China and the United States increasingly diverge. I do not believe we're going back to anywhere close to where we were a couple of years ago. I think this is a structural, geopolitical and economically driven event with forces, the like of which we haven't seen since the Cold War being brought to bear.
Okay, so with the U.S. presidential election as well, this year, how do you really see this impacting markets globally? And what asset class will you be looking at, particularly to see an impact of the same?
Well, I think in terms of asset classes, I think there's really only one asset class at this point to pay attention to, and that's really the equity market. That's the market that's moving. That's the market that's moved parabolically. We're not seeing any sorts of aggressive movements either really in the US currency at this stage. I'm thinking that will change as we move through the year, but we haven't yet. The bond market has been incredibly benign. Given where the equity market is, we should have seen relatively significantly higher yields, but that hasn't happened either. So I think it really is all about the equity market. Now, I think the big thing to watch in the short term is how Bernie Sanders starts to do as we go into the various key dates within selecting a Democratic candidate. It looks to me that he could start to do quite well in places like New Hampshire, which was obviously and Iowa, which were going to be quite significant as we move into the spring. I think those will weigh on certain sectors within the equity market. But I have to say, for Trump, the good news is that, Bernie Sanders will turn off a number of US voters. He is very extreme in his views. And I think that could be a big win for Trump in that sense. So, and we've got a very, very polarized electorate here. So it's actually, if you become extreme and Sanders fights this thing all the way to the Democratic nomination, the reality is certain sectors like healthcare, I think, are going to be impacted because he's got some very, very radical proposals. But I'm not sure that the overall market will pay that much attention. I think the overall market would love a Bernie Sanders, Donald Trump election. The wild card obviously would be if we got someone like Bloomberg coming through. That would be, I think, is seen as probably relatively positive for the market. So I don't think that's a bad thing. And Biden also, I think, would be seen as more positive for the market. But the reality is, I think even there, if you put Trump and Biden head to head, Trump's going to win again. So I think the only short-term risk I see is how Bernie Sanders starts to do and whether he can pull ahead in this race in the Democratic side. I think that will weigh on certain sectors, but not the broad equity market.
Okay, what possibility, Julian, do you see of the Fed lowering interest rates this year? What do you think is the right move?
So, look, the Fed is essentially easing policy again. And I think, we've got to remember there are a number of tools they now have at their disposal. Most notably, they have interest rates and they have the balance sheet. So we've seen the 3 rate cuts. That's a typical mid-cycle easing cycle that we've seen, say, in 1995, 1996. But we're seeing re-expansion of the balance sheet. At the moment, they're quite coy and they like to refer to it as, it's not QE, this bill purchase and this repo expansion. But frankly, if the thing walks like a duck and quacks like a duck, then it's a duck. And all other things being equal, in the past, that has encouraged the dollar to weaken. I think that will. I think what we've got at the moment is a bit of a stasis, though, where rates are still probably a little bit too high here in the US. I think that growth continues to slow. I think the rate of growth decline in the US has probably slowed, but the level of growth is still quite low. I'm still looking for sub 2% GDP growth in the first half of the year. I think that could coincide with continued weakening of the labour market. So look, I wouldn't be surprised to see the Fed cut another 50 basis points by summer. And I think when one looks at the cycle of the dollar, when you look at all the structural things that the US is doing in terms of spending and the deficit, and the fact that other countries are slightly ahead in the fiscal spending route, which actually does stimulate growth. So I think, you've started to see some strength in places like New Zealand in the currency as they've talked about fiscal spending, and also in the pound again. I think all of those factors are going to start to weigh on the dollar a little bit. And I think the Fed will help as they move to try and prop up sluggish growth, not recessionary growth here in the US, but sluggish growth.
All right. Thank you so much for joining us on that, Julian. All eyes will be on the trade deal and the formal announcement that does happen on that.